In this week's update, all signs point to US big tech not having contracted enough, and all the elements are in place for a commodity supercycle. My name's Garry Davis. As always, this is general advice. Please remember to subscribe and like the video. All right, let's start with the market perspective. There's a lot of quite weak US business models are now becoming evident, and probably none more so than Facebook, which really its business model is really being called into great question now. And over time, I would expect to see Facebook's price quite considerably lower, despite the fact that they actually surprised the market on the upside through the week. Microsoft was okay. Their earnings report was okay, and their price has held up reasonably well. I still wouldn't write off the possibility that it also breaks support, but many others already have, including Netflix, Facebook, Amazon, all shockers and looking very bad, and Google as well. They barely made it in terms of meeting expectations, but certainly the share price is suffering a lot of multiple contraction. And if you recall, back in the middle of May, in the last week, March, I should say, I was very cautious about the reversal, a very sharp and very robust 3-week reversal we got from the middle of March, because it just didn't feel to me like we'd had a sufficient washout, a sufficient contraction of multiples of these stocks that had traded on these really high levels for many years. And it's it's really coming home to roost now, and I think we're going to see some further downside yet. But look, the thing to remember here is that all quality, and these stocks like Amazon and Google, they're all absolutely quality companies that dominate their space, and hundreds of others in the US tech sector. And all quality becomes attractive at a price. So, you don't want to turn your back on this market, because if we got a few weeks of sharp downside, it could set up some wonderful long-term buying opportunities. So you really need to remain alert to the possibilities and keep perspective on what's going on, because the mega trends, whether they be in digital technology or whether they be in battery materials or renewable energy, they're going to continue no matter what. It doesn't matter what is happening with with Russia or China or the Middle East or with global growth. They're going to continue. And the further these stocks fall, then the closer we get to a major low. So you really want to get excited about the prices falling, and unless you've either not got sufficient capital or you've not hedged some of your exposure. But it really does set up good opportunities. So just before we go into the US stocks, I'll just touch on, this is the 10-year Treasury. So let's just go back over the last, say, 3 months. So we shot back up to almost 2.9. You can see we had a little bit of a dip earlier in the week, but back almost to its highs. So the trajectory there on the 10-year yield is really strong. And I mean, this is the key chart. This is what the markets are responding to. This is why we're getting these big multiple contractions. And if we look at the VIX again spiked up into the mid-30s. If we look over the last 6 months, you can see we're almost back to the highs that we had in March, when things did look fairly grim. So perhaps a bit more upside in the VIX yet to come. So let's go back and just check on the American stocks. So the S&P ended up falling 3.3% for the week. We had a strong day on Thursday, but then finished off quite poorly on Friday night. And the S&P has now broken key support. So you can expect that we're going to get further technical selling is going to come in. And there are so many companies that are making quite emphatic downward moves, and just about everything closed on the lows. And other than Thursday night, that was the theme all week. There was the selling into the close was really one of the standout features for me. You know, the market's just not taking any prisoners at all at the moment. And the S&P, we've had a couple of little rallies, but it's really been downhill since January 4, and it's off 14%. So we're certainly in correction mode. And you know, at the time in March and late February, I was saying that 3,800 on the S&P was a target. That's still 300 points away. So I wouldn't write off another, 5 to 8% downside in the American market. The US dollar index continues to move higher. It's really surged and it's up to 1.32. 103.2. And the 10-year yield, as we saw, 2.9, and the VIX at 33.5. So let's have a look at those charts. This is the QQQ, which is the ETF covering the NASDAQ. And you can see very clearly all the moving averages have rolled over. We broke support over the last couple of sessions, and clearly the NASDAQ has got further to go to the downside. And look at the volumes. The volume's really quite elevated. If we look at the S&P, okay, so we had important support that really needed to hold here, but didn't on Friday night. Quite a negative close, and you'd have to think that this 3,800 level is very much a possibility now with the S&P. Turning to the spread charts, so this is the NASDAQ versus the S&P. All 11 sectors were down on Friday night, so money was flowing out of the market as well. So not a huge differential move, but clearly the worst performers were consumer discretionary and technology on Friday night. Both down, one a bit less than 5%, the other one a bit more than 5%. So these are big moves. This is consumer discretionary versus consumer staples. This is the chart that really paints a very negative picture. And while ever consumer discretionary stocks are being treated like this, it tells you everything you need to know about the mindset of the market. So Russell 1000 growth versus value, it's still trending down, no question about that. And this is the small caps, small cap growth versus small cap value. Now the other chart I want to take a look at is on the small caps. So this is IWM, the ETF covering the Russell 2000, and you can see we've now, after trending sideways for a little while, we've now clearly broken support on the Russell as well. So wherever you look, it's a pretty grim picture at the moment. And with the S&P and the Russell breaking support, it's not a good outlook at all. I just want to show a couple of other charts. So this is some of the individual sectors. This is XLF, which is the finance sector. And you can see we're now clearly forming lower highs and lower lows. So the finance sector is falling away quite quickly. And that's a little strange given the rising interest rates, which would normally be a good thing for the finance sector. But, clearly not this time. This is industrials, hasn't broken support yet, but looking pretty negative. We've got lower highs and lower lows forming. This technology, but looking very similar to the NASDAQ. XLY, this is consumer discretionary, extremely negative finish last week. And XRT, retail, also looking very negative and is far more negative than some of the other areas of the market. Now this is Amazon, which reported and missed expectations and fell 14% overnight, was down 16% at one stage. And that's clearly broken support, and Google as well. Whilst their result was reasonably in line to expectations, there's a big multiple contraction happening here, and it's hard to know how much further it could go. I think 2200. So picking up this little range of consolidation through here. So sort of just above and below 2100 is a possibility for Google. All right, now turning to the currencies. This is DXY, which is the US dollar index. You can see it's been a straight up run last week, very, very strong. And that has had the effect of really pushing the Aussie dollar down, and we barely closed above 70.04 on Friday. So perhaps below 70 looks likely again. So it should be 70.004, that should be 7004. Now the ASX 200 was only down 0.5% across the week. We'll probably see more falls on Monday, but the ASX has outperformed the S&P by a long way. So the S&P is 14% off its highs for the year. The ASX nothing like that, as we'll see in a minute. But we do have a triple top, and that looks a bit ominous at the index level. So our period of outperformance might get a bit shaken up, although certainly the commodity majors are helping in energy and materials. So big mining, the BHPs and the Rios are about slowing growth in China. That's why they've been under pressure, because with the lockdowns in China, the demand has certainly been showing signs of dropping away. So that's why the big mining stocks have been under pressure over the last couple of weeks. But the small miners, it's really all about decarbonisation and renewable energy. They're playing to a different tune to the big miners. And I believe the fortunes for those companies and their share prices are pretty much unstoppable, but they will be volatile. They'll be hugely volatile because the sentiment of the market globally is so negative. So I think small miners are a great place to be in Australia, but you've just got to be really clear about what you're doing, because some of the moves will up and down will leave you a bit breathless, I think. So let's take a look at that part of the market. So we'll start with the ASX 200, and you can see big triple top, 1, 2, and there's the third one, and 2 really emphatic moves, which were really about the big miners coming off. Now they managed to recover towards the end of the week, but we finished at 74.35. The peak is only 200 points above that. So, we're only 3.5% off the all-time highs, as opposed to the S&P, which is down 14. There's materials. They have certainly helped, and we had a real smashing at the start of the week, but turned around. Energy has continued to do extremely well, and we're still trending up very nicely in energy. Finance, also not too far off its all-time highs. And healthcare has leveled out. So healthcare felt the heat in January and February, hasn't really bounced since mid-March, but certainly seems to have stabilised now. So that's the picture for that market. Now turning to gold, we were holding above this support level at 1915. Well, that broke, so that's very disappointing given the environment for gold, and it finished at just a couple of dollars under 1900. But the point is, we've now broken support, yet again. Gold is, disappointed again, and tried hard to rally on Friday night, but just couldn't hold it. And if we go to the miners, you can see very, very sharp move down on the 21st of April, and then followed through into the early part of this week, and didn't really get any better. We had a nice move on Thursday night, but certainly finished poorly again. So the outlook for gold miners and gold itself continues to look unattractive, is probably the best that I can say. So $18.98 down $35, and you'd have to say that with wars, with inflation, with concerns about all sorts of things, that, and not to speak of the debt and the global economic situation, that this is really an ideal environment for gold, and yet it can't really raise a yelp at the moment. So disappointing. And the miners just aren't offering any encouragement. We did get a brief period there where the miners led the way, which was encouraging, but it's fallen away again. Other commodities, copper and nickel were both down thanks to that very, very strong week for the US dollar, so no surprise there. And crude oil was up despite the US dollar also rising, and we finished at 104 after hitting, I think, about 108 midweek. So there's the spot copper chart. There's nickel off a little bit. So to wrap it all up, I think the most important message I want to get out there at the moment is not to lose sight of the opportunity that's building. Don't lose heart and turn your back on the market because it's just all a bit hard at the moment. Just adjust your position, make sure you've got some cash. Certainly in the US, I think it's advisable to raise some cash. We've got lots of stocks breaking support. So, really you need to be taking some exits or putting some tight stops in place. The possibility of hedging your exposure with some negative ETFs or some put options, depending on what sort of hedging tools you've got at your disposal, but that's certainly worth considering. In Australia, commodity stocks, I think over the next year or two are going to do exceptionally well. But you just need to be clear about your plan and have a good, unemotional trade management outlook, because the volatility is going to be high and it's going to frighten the pants off a lot of people. But that doesn't mean that there's not good opportunities there, because there certainly are. Portfolio analyst last week, we really looked at how to think about a negative market, because that's certainly what we've got, and anticipating what might happen and how you might respond to it in advance is just such a valuable thing to do, because it helps you not to make those unemotional decisions. If you don't think about it and we get a couple of sudden down days in the market, it's easy just to sort of give in to your emotions and want to sell out of things. But if you can think about it beforehand, anticipate it, have a course of action planned out, it's so much easier to make sensible decisions. Now, last week we covered some of my highest conviction and what I perceive is lowest risk stocks, because they've just got so much upside relative to their potential downside. And we looked at some other high conviction stocks as well. All right, that is it for this week. There's my email address and website. I think we're going to continue to see negative trading for a little bit yet, despite the fact that the first 10 days of the month in the US tends to be fairly positive, and particularly at this time of year because of fund flows into superannuation and mutual funds. But when the market's negative and it wants to sell off and the institutions are doing that, then it doesn't really matter. The seasonality doesn't come into it. So I think you can probably expect some more downside, and we'll see where we sit next Sunday. Cheers.